Is the Fed's zero interest rate policy still helping the U.S. economy? Join us as Patrick gets up and walks over to the touchscreen again and speaks to Jimmy Ju of FXPRIMUS when we return.
And now for his views on the FOMC meeting and a quick glance at the Chinese economy, we speak to Jimmy Ju of FXPRIMUS. He joins us from our city studio at OCBC Centre. Thanks for joining us, Jimmy, this morning. Were there any new messages that the Fed conveyed to global markets overnight?
There was little fresh air to breathe tonight. It's clear that the wind from BOE, from Bank of England, has yet to arrive in the U.S. We noticed that Janet Yellen is quite patient and very cautious on the monetary policy progression. And every possible scenario she described was backed up by the opposite one. For those who are looking for the rate hike, exact timing might be disappointed, but we guess the rough timing might be this time next year.
And what are the key words that investors should be paying attention to, do you think?
There are some slightly optimism shown in the FOMC statements, as the Federal Reserve used in the statements like the growth rebound instead of a growth pickup from the previous statement. But we noticed that the Federal Reserve seems not recognize the recent inflation picking up because the inflation-related comments are still remain the same. So that shows the face that the Federal Reserve still has not ready to moving to a more neutral bias.
Is the zero interest rate policy still helping the U.S. economy?
We are not in the crisis now. There's no single policy can solve a different problem in a different economy cycle. One of the Fed President, James Buller, he mentioned that we are very closing to the Fed long-term objective. So the current zero interest rate policy is not consistent with the current economy cycle. And so the Fed needs to return some volatilities into the Wall Street to avoid some bad behavior due to the moral hazard. Also on the Main Street, the persistent low interest rate probably will lower the deposits level because the money is locked with the higher investment. So that will limit the upside of the consumption as well.
Does the U.S. bond market present a fair rate guidance from the Fed?
I think the bond market is still quite accurately to present the current rate guidance and the economy conditions. So the 10-year yield has up about 100 basis points since 2 years ago when the Fed announced the QE on a higher rate expectation. But 10-year yield also dropped 40 basis points since beginning of the year. I think that just priced out some tapering tantrum from last year. Moving forward, given that the Federal Reserve might slightly tightening the monetary policy in the second half of the year, we think the yield will still go to 3% toward the end of the year.
Looking into the second half of 2040, which currency pairs will be most closely linked to the Fed's policy?
This is a very interesting question because if we look at the Aussie Kiwi last year, intra-year it was dropped about 2,000 basis points. It's because of the common effort driven by the RBA and the RBNZ divergency policy. So moving forward, we also expect this kind of phenomenon can appear in the euro dollar because the reason is that the possible ECB balance sheet going to expansion and the Federal Reserve balance sheet could reach the peak. This could drive the 2 years uptrend going to reversal lower. So here's the thing. If the market wants to question the ECB easing policy 2 weeks ago, the weak policy leading to a fragile economy should leading the currency pair lower, not higher.
We've heard China's Premier reassure that there'll be no hard landing in the Chinese economy. He also said that the economy would continue to grow at a medium to high pace in the long term without strong stimulus. How convinced are you about this view?
I agree him regarding the hard landing because of the chance the hard landing over the next few years is very low. As a concern, the credit crisis may not be valid due to a highly domestic funding nature and its closed economy. We also expect the government will be very cautious to handle the property market in a very stable approach. But regarding the high-paced growth in a sustainable manner, it still quite largely depends on the process of the reform, which is the only way to spur the domestic consumption, which currently is still in a very gradual pace due to the concern on the social stability.
China's second quarter growth appears to be on a stable footing. Can this momentum continue into the second half of the year?
I think the second half of the year that might be some slightly challenged due to for two reasons. Number one reason is there's a limited space for the channel for China to continue to ease for pursue its reform agenda in the second half of the year. Also, the other reason is if we noticed last year, the second half of the year, the growth base is quite high. So that probably will challenge the China second quarter growth data. But the good news is the second quarter data for this year could be quite surprising. We expect it to reach around 7.5% this quarter.
All right, just one last question for you, Jimmy. What's your forecast for China's flash manufacturing PMI next week?
I think the China manufacturing PMI for next week still poses an upside risk, maybe 1250. Our forecast is 49.8. The ongoing mini stimulus and the sound recovery of its major export partner like Germany and U.S. still support the manufacturing activity in China to offset the downside risk of the property sectors.
All right. Well, thanks very much indeed for that. Jimmy Ju of FXPRIMUS there.